You're listening to QSBS Solved, where we share insights for founders and investors looking to maximize their business's growth, exit opportunities, and tax savings. Our team at QSBSrollover.com offers specialized services to help you benefit from owning qualified small business stock. Our podcast guests are leaders in their respective fields and work on every side of the startup journey to help founders and investors win. The ideas and opinions shared here are not investment, tax, or legal advice. Reach out and we'd be happy to connect you with a qualified advisor or tax counsel. For now, enjoy today's episode.
Well, hello, and thank you for joining us today for our webinar on understanding the One Big Beautiful Bill Act's implications with respect to the changes to Section 1202. I'm Brian Masterson. I'm a partner with Frost Brown Todd in the Nashville office. And today I'm joined by my partner, Scott Dolson, in our Louisville office. And for many of you on this webinar, you probably know Scott through his extensive writings, and we'll talk about that in a few minutes and provide a link that everybody can access Scott's writings. And also we're joined by Brady Weller, who is a director with QSBS Rollover. And as the name of his company suggests, Brady has extensive experience with all things 1045 and strategic planning around 1045 and QSBS as well. So before we get started, I want to run through some housekeeping items. The first one is today's session will run approximately 60 minutes. We're mindful of everyone's time, so if anything, we'll try to end maybe a couple minutes beforehand. Also, we encourage you to submit questions through the Q&A function located at the bottom of your Zoom window. The three of us will be taking a look at that and trying to monitor that as we're going through today's webinar. And to the extent that we can't get to one, we'll certainly follow up with you afterwards. So let's go ahead and get started. And I mentioned this a few minutes ago. Scott is prolific in his writing on all things related to 1202 and 1045. And so here's a link to where all of the articles that Scott has written are warehoused on our website. Tremendous resource. We know that a lot of you look at those. A couple of other resources we want to make sure that everyone had access to. Our tax group has done a pretty good job addressing a whole bunch of different issues with respect to the OBBBA. And so if you click on that first link, you'll get to our OBBBA landing page, and you can access all of the articles that we've written basically over the last probably 3 weeks dealing with various tax issues.
The second question, do you do that? But people watching have access to your slides. In other words, that
great
link.
Question in terms of being able to click on the link. Great question. So what we'll do when we get finished with today's program, everybody who is registered will get an email with a link to this slide deck, which then has live links to each of these landing pages. And you'll also get a link to a recording of this webinar as well. So they don't have it as we sit here now and the ability to click on it, but these are live links. So when we do send a slide deck later today, they will have access to it. So great question. The second link is to the article that Scott and I wrote. We published it initially on July 3rd, which is when the House pushed the bill through by a 4-vote margin. But I will also tell you, check back frequently because as issues come up, and we're going to talk about some of those issues today that Scott and I have been dealing with over the last now 4 weeks, we've modified that. So I would tell you there are different publications that have picked it up, and they may have picked up the July 3rd version, but Scott and I have made changes even as recently as this morning to it. Again, those changes are coming in through different issues that we have clients and prospective clients asking us about 1202 post the One Big Beautiful Bill. So the link that we're going to provide you is to the most recent version of that. So let's go ahead and get started, and let's talk a little bit about what the One Big Beautiful Bill did. I'm going to kind of hit some things, then I'm going to ask Brady and Scott to weigh in with their general thoughts as well. But July 4th, 2025 is a date that I think those of us in the 1202 space, it's kind of like it's going to be a key moment in time in the sense that if you have QSBS that was issued after July 4th, then it's under a different regime. All these changes we're going to talk about in just a minute, they affect stock that was issued after July 4th. Stock that was issued on or before July 4th is under a different regime. And so a lot of the questions that we're fielding, and in fact, one of the changes that we made today to the article that we have on our website deals with, as you can imagine, and I'm sure you guys are, those of you who are practitioners in this space, whether you're accountants or lawyers, are also feel these questions, which is, I have pre-OBBBA QSBS. How can I make it post OBBBA QSBS so I can take advantage of these rules? And so we're going to talk about that particular issue, which has been a hot button issue literally from day one on them. So next bullet point, the three significant changes that we're going to deal with are, number one, there's a tiered holding period structure. And we are going to talk about the tiered holding period structure, which is 3 years, 4 years, and 5 years, and the different applicable percentages that apply there, and some of the debates that are ongoing with respect to the 3-tier holding period structure. The second one, which got a lot of attention, rightfully so, is the increased 1202 exclusion cap from 10 million to 15 million. That 10 million had not been adjusted for inflation, and so the 10 million was getting to be smaller and smaller as we are living in a more inflationary time period. So that $15 million plus adjustments for future inflation, that is, it's helpful, and we'll talk a little bit about that. The third point that we're going to talk about is the increased gross asset test. It's been at 50 million forever. And we're going to talk about how that really is not kept up with inflation at all. And it was not adjusted for inflation. So how could it keep up? Now it increased to $75 million, and it will be adjusted for inflation. And this is a point that we made in the article, which is 1202 came into existence during the Clinton administration, and Obama actually expanded it. And now we see Trump in his presidency expanding it even more. So our view on this is, from a policy perspective, we view this as the federal government wanting to encourage investments in startup enterprises or small businesses. So, but one of the things we're going to talk about is, given some of the changes that have taken place, especially in the context of 174 campaign, you may be surprised at what is a qualified small business now. So it just doesn't mean that it has to be a startup or a venture enterprise. It can be broader than that. We'll talk about that. But the point that a lot of times, the reason I want to make this point is because there's not a lot of guidance on 1202. And so a lot of times we're left with, well, Iris hasn't addressed this issue. The courts haven't addressed this issue. And it goes back to, what is the policy behind 1202? And do we think that whatever a client is trying to do is consistent with that general policy position? So that's why we wanted to make sure that we kind of thought about this from a policy perspective as well. So, Scott, do you have anything you want to add in terms of how we shape what we're going to be talking about for the next 50 minutes or so?
Yeah, I mean, just a couple of things. I mean, changes here, I mean, they do move the dial somewhat on making the potential return for investors better. I mean, it's still, you're hitting the home run if you end up qualifying. But, if I'm, at the margin, that whether you're going to buy a municipal bond versus invest in a venture startup, the potential return is greater now based on these incremental changes. So I think the changes do help. I mean, I think where, we mentioned this in our article, I mean, where people have problems with 1202 is, I mean, there's the problem of it just helps a narrow group of people rather than American taxpayers generally, but I mean, that's the complaint of some people, but other people might say that, that 1202, it's just sort of a static thing that, once it's there and it doesn't get interpreted, like you say, is it really achieving what was intended from a policy standpoint? I'll just give one example. I mean, one that's clearly something you're able to do. I mean, we can form a C corporation and do a software startup, and we can, encourage investment by saying, hey, you might get 1202. I mean, there's no doubt that's what Congress intended. But, we can also form a C corporation, and we see a target company out there, a $30 million software company, and we can buy the assets of that company. And there's nothing in 1202 that would prevent us from doing that. So, I mean, that's, some people might say, is that what was intended? And, my answer to it is, well, a startup has to buy a laptop, right? Or your desk or anything else. So where do you draw the line? I mean, what's the limit? And 1202 itself has none of that. But I mean, some people would say, that's beyond what the original intention was, but it's clearly not beyond what the statute says.
Well, and Scott, on incentives, there's an incentive for the government to put more businesses under the C Corp tax structure, I think. And so, there is a benefit from their perspective on having more businesses maybe paying that tax rate or double taxation in some cases. I guess the other thing I would mention on incentives is, you said that it encourages startup investment to mention to potential investors, hey, you could claim 1202. And I actually think that the incentive is often bigger than the benefit, if that makes sense. I think more people are incentivized to put capital in than actually end up benefiting. I mean, we saw a Treasury report from earlier this year that showed that less, each exemption claimed was on average less than $5,000, I believe. So in general, the dollar amount benefit on the median or average, forget the number, is not incredibly high. But anecdotally, I can say that everyone we talk to in our space around startups, founders, and venture, they know QSBS, they know 1202, and they're incentivized by it from a psychological level, at least.
Yeah. Yeah. I think the other thing to sort of say at the 50,000 foot level on this is, it's what these changes did and what they didn't do. I mean, what they didn't do was, the corporate tax rate stayed at 21%. It didn't go to 28%. There was some, rumbling about that, right? And also, back in the Biden era, there was they tried to push through an amendment to reduce the exclusion from 100% to 50%, which is kind of knocking 2/3 of the benefits off. Instead, we had these changes that are positive changes. I honestly think the biggest impact of this is, I think all three of us probably talk to people where they're doing a choice of entity planning. I mean, if you're in Silicon Valley, I guess with preferred stock investors, you're going to go with the C Corp. But in the rest of the country, there's a lot of people that have been, sort of touting the benefits of pass-through entities, and but they're hearing about 1202, and this has been going on now for a number of years. And when you're trying to balance the benefits of a pass-through entity versus this, the problem has been, I don't know how many times I've said, none of us have a crystal ball. You invest in 1202 stock, it doesn't mature for now. It can mature in 3 years, which is a big deal. But, before it was, well, we don't know 5, 6, 7 years out. We don't really know for sure, number one, whether you're going to qualify. Are you going to find a buyer? Is this statute going to still be there the way it is today? All of these were open questions. And I think at least we have, in this moment in time, an endorsement, I think a validation of 1202, an endorsement of 1202 by the government, that this is something that they not only didn't want to trim back, but they wanted to make, more favorable. So, I mean, I think that really is probably the biggest message overall. I don't know what the two of you want to say. Think about that.
Well, I'll add a couple of things. You can see it here on the slide, third bullet point under support. So David Kustoff is a Republican congressman. He represents basically the Memphis suburbs in Tennessee. And so in February, he had sponsored legislation, and he's done it before, so it's not new. But he had sponsored legislation, and you can see the House Representatives bill number there. He sponsored legislation that did have this three-tier structure, that did make it into the one big, beautiful bill. He also had two other things that I think are pretty important that would have expanded it 1202 even more. The first one was with respect to convertible debt. You have convertible debt, and so the holding period for QSBS would include the holding period with respect to convertible debt. So if you have convertible debt that you converted into stock that became QSBS, the current rule is, okay, your holding period for QSBS purposes begins upon conversion. Well, in the Small Business Investment Act that was introduced in February, your holding period would not only include the holding period with respect to stock, but you would tack onto it the holding period with respect to the debt instrument. And so that would have greatly expanded in terms of the availability of taking advantage of the benefits, whether you're in the three-tier structure in years 3, 4, or if you make it all the way to 5, it certainly helps you get further along. The second key point that was in Representative Kustoff's bill that did not make it into the one big beautiful bill was it expanded eligible corporations to include S corporations. So it was not just limited to C corporation. That's something, again, that had been in prior bills that have been introduced by David Kustoff. And those bills were supported by the two associations, the Venture Capital and Angel Capital Associations, you can see there. Again, not surprisingly. The next point I want to make here is under the criticism. So the angel investor loophole. So my view when I hear people talk about loopholes is if it's statutorily provided, 1202 is clearly statutorily provided, it's not a loophole, intended. So all that conversation that we just had about, this is arguably further congressional and executive branch and hopefully, judicial endorsement eventually of encouraging investments and incentivizing investments in startups. So I don't really call it a loophole because it's clearly intended. Loopholes are things that are unintended consequences, at least how I would define a loophole. Now, when we talk about the next line, just a few minutes, when we talk about the three specific changes again, the question is going to be, what are people able to do with respect to that effective date before and after that effective date? So that's where you have unintended consequences. So we'll talk about that quite a bit more over the balance of our time together. Brady mentioned this
slide, Brian, on this slide, estimated cost, the $44 billion was what it cost with no amendments.
Yeah.
But the additional amendments are like 17 to 18 billion was the estimate.
But it's not very expensive. And so back to Brady's point, the incentive, maybe it's more psychological or maybe it's more anecdotal. And this is where, again, the federal government is saying, we want to incentivize, we don't want to create a disincentive for startup investment. In these particular industries or these particular services, we want to incentivize it, full well knowing that not all startups succeed. And so a lot of the clients that we work with are the ones who have hit home runs or who have hit triples. There are a whole lot of people who struck out. And so that's where they still took the incentives, hoping that investors or founders would be able to benefit from 1202, but the business failed. So this is a way for the federal government to still incentivize that activity in what may be a high risk endeavor, which is basically any startup business, arguably. All right, let's move on and let's revisit what's going to shape what we talk about for the next 40 minutes or so, which would be these three changes. And the point to note, we've talked about them before, and you can see them on the slide, is, again, you got to keep in mind July 4th. And so even this morning, Scott and I were dealing with a fact pattern to where we have a client who has QSBS that was issued before July 5th. And their question is, how can I do any sort of restructuring in order to get into a post OBBA timeframe? And so those are issues that people are wrestling with now. And my view on this is we've not seen a whole lot of, and I'm going to knock on wood, a whole lot of IRS activity with respect to 1202. We don't have a lot of cases dealing with 1202. We have some cases that have been written about, but it's not a huge amount of case law here. I mean, if I were prognosticating here, I would think that to the extent that people, shareholders, try to play games with the July 4 date. So if they try to take that pre-OBBA, QSBS, and take a very aggressive position with, oh, I did this restructuring type transaction, and so now I'm taking the position that the stock that I'm selling, 5 years into the future, sometime post 2030, qualifies for the $15 million exclusion, not the 10, even though you could trace the stock that I'm selling in 2030 and beyond back to a pre-July 5, 2025, a position that's eligible for $15 million, not 10. It would not surprise me if that becomes a point of contention with the IRS on exam. So it's one of those issues to where talk about the intent. And my view is the intent was pretty clear, which was it was to be a line of demarcation. We're going to talk about different statutory provisions where we think that would be the case. And so I'm going to flip to the next slide, Scott, which is an issue that I know you've been thinking a lot about, which is, okay, how can I, or am I limited, boxed in on trying to basically convert pre-OBBA QSBS into post-OBBA QSBS? So why don't you walk us through the law that we see in 1202I, plus the new references coming from the OBBA to section 1223.
Yeah. Well, there's two obvious ways that, somebody might try to think that they can convert, pre-July 5th qualified small business stock into post-July 4th qualified small business stock. One way is, what about a stock for stock exchange? And that's a section 351 transaction. You contribute your stock to a new holding company and get the stock of that holding company, or you in a 368 transaction, and it looks like there's a 358, so there's a typo in the slide. So 368, merger. And the problem with that is, and none of this has been interpreted obviously in any tax authority at this point, but if you look at the rules relating to the, the 351 or 368, you look at the statute, 1202, and it says such stock shall be treated as having been acquired by the taxpayer, at the time you acquired the original stock. So the holding period, started then. So, if that's the case, that the exchange stock, so the original stock. So that's the pre-July 5th stocks. If that provision doesn't say expressly that it's intended to, make this distinction, but, if I were interpreting and giving somebody my thoughts on it, I would say, that provision is a hurdle that I'm not sure we can get over. So, that would be one possible way somebody might think, well, it is issuing new stock, so, why wouldn't it be stock under the new rules? The other way is if you sell your original stock and you reinvest under 1045, and this is definitely kind of within Brady's sweet spot of what he deals with all the time. There were provisions in place dealing with the old 50 and 75%. These rules were around since 2010. And they basically, the language is pretty obscure, but I think basically all the people that talk and think about this think that the language in the statute is intended to say that if you sell stock and reinvest under 1045, and the stock you sold was 50% stock under the old rule. So let's say it was 1997 stock. You sold it, you bought new stock, replacement stock today. If you do that, your new stock is still 50% stock. Okay. That's what this language in the statute is interpreted to say. So when they wrote this new provision with this ratcheted, 3 years and the other stuff, they said, well, they put the same language in. So, and basically they talked about section 1223, and 1223 has a reference to how it functions under 1045. And I know this is just a lot of section references, but the gist of it is that 1045 looks like it's shut down as a method to convert pre-July 5th stock into post-July 5th stock. So those are two obvious ways where somebody might want to try to make that switch. Brady, I don't know if you have any thoughts on that, or Brian. And
yeah, that's exactly, it's the day after it was signed. That was what we were digging into is this an opportunity to accelerate someone's ability to take at least partially tax-free gain? We kind of came to the same conclusion as you. And I think insofar as there are planning opportunities where, a whole new corpus started and the holding period resets and all of that, but you're not going to have your cake and eat it too, keep your holding period and also be able to align under the new rules. So yeah, I think we're definitely there with you. I did also see that in the Q&A section, we had some comments about common and preferred. Can existing C Corp issue preferred shares post the 7-4? Scott, I know that we had talked a little bit about that on our planning call. Maybe you want to speak to that. Then the other was, is this when shares are issued or vested? And that's when all these rules are in effect at the date of issuance, not a vesting date or option vesting or anything like that. It's actually when shares are issued to the holder.
Well, if the shares are restricted,
well, that's another,
and they're not treated as issued for federal income tax purposes yet. So if somebody has restricted shares and the shares vest today, then that today would be the date of issuance for federal income tax purposes. So, that there's really vesting, it's really restricted and unrestricted shares. If you were issued shares back, on June 1st, and you filed an 83B election, even though they haven't vested, they're treated as being issued for federal income tax purposes. So
we talked with a lot of employees, right, who have ISOs, and they think that their QSBS clock starts when, their first waterfall or when they get their ISOs vested. And so, yeah, something to mention. It is different if you have, your 83B and you have RSUs versus if you're just an employee and you have options. Vesting doesn't do anything for you with your options.
Yeah. There's an article on our website, a couple of them that deal with incentive compensation, and those rules haven't changed, and it's really the key is, when is stock treated as owned by a shareholder for federal income tax purposes? Mm-hmm. And that for purposes of this pre or post Trump bill, whatever we want to call it, is the key thing. So that's the answer to that question. And I'll just mention one other planning idea. So it's possible that you might do a business freeze where let's say you have a company worth $20 million. It's possible to say, okay, we're going to recapitalize in an e-reorg, and we're going to issue preferred stock for $20 million. And we're going to, sell, I call it kind of cheap common stock. And that would be, at least on the face of it, post, July 4th stock. Now, the problem with that is if the only reason you're doing is to try to get in your hands some, post July 4th stock, then I think if I'm the IRS, I'm going to look at that and say, what's the bona fide business reason for doing it? So I think it's kind of, it's not on the face of the statute, but I mean, I think that issue's out there. Now, you might do a business freeze because you want to have cheaper stock, common stock to issue in connection with adoption of an employee plan. So a non-pro rata sale of common stock, or bringing in new investors, or you want to do that because you're doing a rollover. In other words, if there are business reasons outside of basically trying to figure out a workaround on this bill, I think it's possible. And there may be other ideas, but I'll just throw that one out there as a possibility that we've been
Scott, I'll jump in. I think I like that. And I think one of the positive, and you can tell me if you feel this is positive too, one of the positive facts there is that I assume that the holding period would reset to day 0 on the new preferred issued. And so that feels, well within, that just feels like a really good fact. It's not like you're taking on previous holding period and you're getting to sort of shortchange the benefit. You'd still have to be in holding that new stock for 3 years to get any kind of benefit beyond it. And so that, that feels really good to me. It's not a crime to incorporate a certain way to get a benefit, so I think that's interesting, thinking about it from the perspective of, does your holding period reset or not? It's probably a good thing if it does.
Yeah, I'm sure it does on the newly issued stock. You would start with a new holding period. I definitely would want to couple that with a business purpose. You don't want to do a pro rata with all existing shareholders, because it's basically just like a stock split or a stock dividend or something. It basically would not work. It would be under one of those reorg provisions probably that would, you look back to the other stock that you own. So I just throw it out there. There is some opportunity there on that, but the facts have to fit the situation to make that work. And I mean, it's really limited why you would want to do that, because for 90% of the people we deal with, we can deal with the $10 to $15 million issue by gifting and that kind of thing. So you're really, there could be the unusual taxpayer where none of that works, but probably would be looking at the 3-year issue where maybe somebody is saying, I want to explore this because I think we're going to sell the company 3 or 4 years from now. But if they've already got a holding period on their original stock, it's going to be a very unusual set of facts where it's really going to make a big difference. On the other hand, the ability to issue additional QSBS, the 50 to 75 million, there might be some, situations where, that's a good thing, and that we need to be looking at that we were basically over 50 million. We issued a bunch of stock, let's say, pursuant to a employee plan. Now we basically go to the 75. We could maybe adopt another plan and issue some more stock. So I may be getting ahead, but trying to look at situations where this can be a critical planning issue, that might be one of them.
Well, I think what I would, my view on this is, and I mentioned a few minutes ago, is I think this is where there might be audit activity in the future, because if I have a fact pattern to where it is clearly an incentive and I'm not able to do some of the traditional planning that we've done with respect to stacking, and I do need to take advantage of that extra $5 million of 1202 exclusion cap, I do think, and again, based upon the questions that I know all three of us have gotten over the last month, this is an area where people are paying attention to this pre and post OBBBA issuance of stock. And the point of the slide is 1202 was aware of that. So Congress was aware of the issue. So we go back to legislative intent. Congress was aware. Congress's intent was to make that difficult. Query whether or not it's impossible, and we can, and that's where I think creative tax planners in the future, you ask us in 6 months, you ask us in a year, what are people getting comfortable with as we've explored this particular issue more and more and more? The answer may change from where it is now, but full well knowing back to we're talking about what was the federal government's kind of policy and intent. Yes, we want to encourage investment. It's not a loophole, but do we want people to play games with the effective date? I would argue Congress would say, no, we don't, given what's in 1202 and its attempt to incorporate by reference the principles of 1223. So this, let me say, stay tuned for this. This is an evolving, fluid type of analysis.
We've been talking about these changes, but we haven't sort of introduced them. We probably ought to, with our time remaining, at least next 10 minutes or something, go through the three basic changes. So we've got it out in front of everybody.
Sure. So here's the first one that we've talked about, which is this tiered holding period system. And this is where if you've got at least 3 years, but less than 4, you've got a 50% exclusion, at least 4 years for less than 5, a 75% exclusion, and then 5 years and beyond. It's not more than 5 years. It's 5 years. So you could do it on the anniversary, 5 years and beyond, then you get 100% exclusion. Just kind of want to walk through a basic fact pattern. I know there's been some debate as to how the exclusion percentage works. And so as we've been kind of looking at this issue, I dusted off old materials that I had that were back from the late 90s to try to see how we were doing things back then, because it's not something I've really had to think about since we've been in 100% for so long. And so here's a pretty simple fact pattern. I'll distill it down. You got $20 million of realized gain. So at this point, I know I'm above 10 and I know I'm above 15. But if this was clearly issued post OBBBA in this fact pattern, so I'm dealing with 15 at that point. Held for more than or held for 4 years. So I know I'm not in the 50% and I'm not in the 100%. So I'm in the 75% exclusion percentage. And so you take the 15 million, it's post OBBBA, 15 million multiplied by the exclusion percentage of 75%. So we can exclude $11.25 million. So the $20 million gain, 11.25 is excluded. So then that's going to leave 8.75 left. So the way you deal with the 8.75 is the 25% that was not excluded under 1202. So that's the 3.75. That is taxed at the special QSBS rate plus the 3.8% net investment income tax that everyone knows and loves. So that's a 31.8% rate that's applying. And so you can see in the right column at the top, we kind of walk through the effective tax rate for that $15 million of gain was eligible for the 1202 exclusion. But I'm not done. So it's a $20 million of realized gains. So we've accounted for 15 of it through 1202. Again, 11.25 was excluded due to the 75% exclusion percentage. 3.75 was taxed at the special QSBS rate. The remaining 5 million, so the excess over the QSB exclusion amount, that excess is taxed at your regular long-term capital gains rate plus the net investment income tax. And so that's how we kind of divvy up, or how we think you should divvy up that $20 million exclusion. Scott, is there anything you want to add about that? I know we've talked about that some even this week.
Well, I mean, this is a new question I'm going to throw out to the two of you guys. Is 1202, is that provision a optional, or is it a mandatory provision? Because you look at 1202, it says, in case of a taxpayer other than a corporation, gross income shall not include, and it talks about the applicable percentages under paragraph 1 are included as follows. I've been thinking of this as a new option. Like every day I have a call with somebody, I'm selling after 3 years, right? And what are my options? Do we go through the different options, stock for stock exchanges, don't sell until after 5 years, 1045. So here we have this new one, and I've been kind of viewing it as, well, this is a fourth option now. Is it a fourth option, or is it telling you this is what you have to do? Other than the 1045. I mean, are you, I guess you can do the 1045. So maybe that's how it functions, but so it's telling you if you sell after 3 years. So I guess it doesn't matter if you sell after 3 years, you either are doing a 1045, you've done a stock for stock deal, or you're not doing the deal. But so the wording, I guess, doesn't matter. But I mean, I guess that's all I'll add to it. This is probably functionally the real change. The other two changes, if you look at the inflation rate, like 120% over the 30 some years. So you're really catching up halfway on inflation with the other two changes. This is really the big planning change, if you want to look at it that way.
And to that point, so we have created a point that was made earlier that I think Brady made about choice of entity. So we have created a choice of entity model that we use for clients who are exploring, do I convert from a partnership entity, let's say it's a multi-member LLC, a partnership, or do I convert from an S Corp to a C Corp because I want to take advantage of 1202? We have a model that takes into account various factors that are unique to that particular client. We look at their pro formas, we look at how much distributions, and we try to give them an idea as to whether or not 1202 makes sense for them. We're also going to, and it's not yet done, bootstrap on this and model with respect to this tiered holding period structure so that a client can see what sort of benefits and actually model out. I have, let's say that I've converted from an S Corp to a C Corp, but I've been operating for a while as an S Corp or even a partnership. And so I have EBITDA, an historic EBITDA. And so a buyer comes along and says, well, you've been in business a lot longer than you've been a C Corp, and so I can see that you're a valid business and here's how much you're willing to pay. And that may come along before you're at the traditional or the old pre-OBBBA 5-year cliff holding period. So now this introduces another factor and it says, oh, well, if I sell, and I'm getting the 50% exclusion percentage versus if I wait a little bit longer and maybe do it when I hit 75, how much is that going to save me if I can get into that next band? And one of the things that we're going to have Brady talked about in a little bit is it also opens up your horizon with respect to 1045.
Yeah, I was going to ask Brady, you deal with this every day. Now, when you're talking to somebody and you're trying to, work with them about should they do a 1045, how do you factor this in, or what's the sort of thinking about, the opportunity of the 1045 versus, let's say we're into these tiers here now. How does that look in terms of the thought process?
Well, it certainly expands the opportunities that you might have in terms of the types of businesses or the potential exit structure of the types of businesses that you could roll into. For instance, under these new rules, it's very possible that someone could, we just talked to someone the other day who had a full M&A transaction exit an AI business at less than a year. And so we're going to see that. I expect to start seeing more clients over the next 18 months who are in a similar situation post July 4th issuance. And while they've only held their stock for 1 year, they may be able to do a rollover. And, if they can get liquid on that second entity at, 2 years beyond and take 50%, that's really interesting. So I think it shortens the amount of time in general that someone might have to hold a stock in a rollover business to get some kind of benefit. And so in the past, if someone exited at year one, they'd have to be in that next business for 4 or 5 years. The longer you have to be holding stock to receive some kind of benefit, the higher the opportunity cost and the higher your risk for something going wrong during that period. So I just think that it expands the number of opportunities and the types of opportunities that maybe are available to you, given that basically at any point that someone exits now under these new rules, for instance, our firm can help them take some amount excluded with a high, a very high likelihood versus in the old rules maybe. So that's one thing. One thing I would say, I would just make an overarching comment that, I would assume most advisors, whether it's CPAs or tax attorneys on this call, I mean, this is 15 years since we've really, maybe let's call it 13 years, since you've had a lot of clients who are kind of in this in between, or could have been, say, pre-2010 or post-2010, whatever it may be. So I would imagine that a lot of this calculus and a lot of this planning is going to be totally new for the majority of advisors. And, we may see some innovation, some interesting, curious to see what comes up over the next 12 months or so, because we expect to start seeing these clients here, like I said, within the next 18 months. It's just not applicable right now, and it probably won't be until that time, but we'll start to see it.
100% true. So I think people, instead of, again, we've been fixated so long on, 5+ years or more than 5 years, to where now, and that's what we're testing with our model that we're working on now, is I think there's still going to be good benefits if you get to 3. And that makes
100%.
all us people to say, I'm ready to exit at 3 and I'm comfortable. Because that's a nice double. It may not be a home run at 0%, but I'll take 15.9% over 23.8. So,
well, for rollovers too, Brian, it allows someone maybe exiting at year 3 under these new rules to have some tax-free liquidity on day 1, some portion of it at least, and then to roll over the excess, which, they just don't need in the short term, and try and, defer that gain, put it into something else, maybe that expands their per shareholder cap, or, there's just, definitely more opportunity here when you can get some tax-free liquidity up front.
100% agree. So the second big item was the increase from $10 million to $15 million. And again, that's going to be indexed for inflation going forward. So it will not stay put at $15 million. So that increase, and we've talked a fair amount about how that caught a lot of people's attention with the desire to want to have pre-OBBA, QSBS somehow converted into post, one big beautiful bill. So post July 4th. So that was kind of the headline lead. And one thing that has come up from a planning perspective is what I want to talk about in this example. And that is, we do think it matters if you have both a pre and post OBBA blocks of QSBS, the order in which you sell them, I'm not going to say always matters, but I would say you need to test it and model it out to see if it matters. And so the example that we gave in the article was, let's assume that we have a founder who had low basis, but stock, pre-OBBA stock that was worth $10 million, and also post-OBBA stock, also again, founder stock, low basis, also worth $10 million. So we have $20 million worth of stock that's held by a founder, and the founder wants to do a staggered sale. So sell one block in 2032 and another block in 2033. So the example may not always be realistic in the sense that in most cases, founders are exiting completely because, bigger companies wanted to come in and buy the whole enterprise, but that's not always the case. So you could have a staggered or a fact pattern where the purchases are staggered over 2 years. And so our view is you would want that pre-OBBA stock to be sold first. And then take that full, and again, I'm assuming $10 million sales price, low to no basis, so $10 million of gain. Then you've taken advantage of that $10 million exclusion cap that existed pre-OBBA. Now the question is, how much do I have left? So I've got another $10 million worth of stock that I want to sell the following year. And again, we're in 2033 now, so we're well beyond the 5 years from 2025. So we're at 100% exclusion percentage. And so the question is, I'm also going to have a $10 million gain in 2033. As an example, how much can I exclude? The answer is spot. million at that point. So you're going to be able to get the full $15 million exclusion value, 10 in 2032, which is the first year of sale, and then 5 in year 2, which is the second block being sold. If you'd reverse that and it sold the post OBBBA first in 2032, so in year 1, then I only have $10 million of gain. I would have been tapped out at that point. And so I would have basically lost that extra $5+ million, again, indexed for inflation. So that's where we say the one big thing to kind of pay attention to here, setting aside the whole issue about the effective date and can I take pre-OBBBA QSBS and convert it into post. We think here, if I've got 2 different blocks and I'm not having that conversion issue, then you got to pay attention to which block do I sell first, because in our view, we do think that matters. Scott, I know you and I have talked about this a fair amount. Do you have any comments on that?
Not on that, but I did want to make one comment back when I was talking about, this whole thing about the 1045 and the language there that relates the stock back to the original stock. So with the 3 changes, I don't know that we've gone through all 3 of them yet, but
We got one more left.
the one where it doesn't hurt us is if you relate back to the original date of the original stock that you had, then, this 3, 4, 5 year thing, let's say you've got, 3 years and you elect to roll over under 1045, it works. In other words, you just keep on going in terms of your holding period. So there's no adverse aspect to relating back to the issuance date of the original stock. It just allows you to continue on to get to the 5 years. On the other hand, the other changes, the 50 to 75 million in aggregate gross assets, the 10 to 15 million in gain exclusion cap. Now those, if you're looking and saying it relates back to the original stock, then those would be under the old regime. So it does get a little bit complicated, but if Brady's working with somebody and they're like, well, we're going to go 1045 because we don't like the 3 years, we want to get to the 5 years, that isn't hurt by the way the wording is here. In fact, it clarifies that the holding period starts back when you bought your original stock. And so if you sell after 3 and roll over under 1045, you've got 2 more years to get to the 5 years.
Last point I want to make before we move to our third and final change, which is the increase in the gross asset test, is don't let the headline of the increase from 10 to 15 take your eye off the ball that we oftentimes see the clients who hit the grand slam with, which is the 10x. So don't forget about 10x. 10x still is there. And if you're hitting that grand slam, 10x will be more than 15 million index for inflation. So don't forget about that one. So the third and final big change coming out of the One Big Beautiful Bill Act dealt with the increase in the aggregate gross asset threshold from 50 million to 75 million. And as I mentioned at the top, even that 75 does not, the 50's been around since 1993. It does not address where we would be at $112.7 million if we were to, apply true inflation, but it's getting there, and then it will be adjusted for inflation going forward. The key thing I think, and I'm mindful of the time here, and so I want to jump to this point. I would say you got to pay attention to 174 Cap A. So 174 Cap A provides for full expensing of domestic R&D. I don't care that it says R&E. I don't know that you're going to be able to get me to change and call it R&E, but R&D. Here's what's fascinating about it, and that is, and Scott and I have talked a fair amount about that this week as well, given what some of our clients are dealing with, and that is, yes, it's effective for tax years beginning after December 31st, 2024. But there is a provision that says, well, you can make it retroactive to 22, 23, 24, but you need to amend your tax return. So then the question is, okay, so we're going to understand, but why would I want to amend And the reason you'd want to amend is from a gross asset test perspective, you're looking at what is basically my net basis in that asset after I've taken into account depreciation, or in this case, the 174 cap A expensing. If I file amended returns and claim that with respect to 22, 23, 24. So what you're effectively doing is, if you thought at the time you issued stock in 22, 23, 24, that you were above the $50 million test, well, you amend your return, take into account full 174 cap A, you may be below the $50 million. So that's something that Scott and I have been talking a fair amount here. So Scott, why don't you address that point, and just know we've got only 5 minutes left.
Well, I mean, I think that, there at the margin, there'll just be some companies that maybe were over the 50 million, but with this amendment, and a retroactive, amendment of their return, it'll take them under the 50 million. And, you could argue, the question is, you issued stock during that period. Is that stock QSBS or not QSBS? And I think it is. I think, the amendment of the return, basically Congress said you could go back and basically retroactively change this. So I think it would, amending your return is going to cause everything else to reset in your return. Why is the status of stock as 1202 any different? So, and let me just, I was actually, while you were talking, I was reading, somebody's question, and I think it's a good one to at least throw out there. A couple people have said, well, my company's not done very much. Why can't I just liquidate it and start over again? And that's a good question. There is this doctrine of liquidation reincorporation that's been around for 50 years, and it's possible, it's going to be very facts and circumstances oriented, but it's possible that the IRS might, essentially repurpose that concept that was used in other ways to attack a situation where somebody liquidates a company and reincorporates it. The same thing could be said, under a 1045. We got questions. So we're doing a 1045 and we need to resize things, and we're worried about hitting 2 years on working capital. So hey, let's just liquidate, claim another 1045 and start another company and restart the clock on working capital. And I've thrown out the same issue. I can't point to tax authority under 1045 and 1202 that applies the liquidation reincorporation doctrine, but I think that's an issue. So, but we're very much in a evolutionary period of analyzing these issues as they come up.
One last thing, Brian, if I can, I think this is the most significant change that we're seeing on our side, especially with venture and companies that raise venture with regard to the 50 to 75, and that's that the data that we have on median funding round from seed to A to B is about $56 million combined, which means that previously, after a Series B round was closed, just because of the cash injection to the business, most of these businesses would have been above 50 million in the old rules, which means that new hires who were issued stock or incentive options after that period, would kind of be out to dry. Potentially other investors coming on late. But now, even stock issued after Series B for the majority of startups raising capital could fit under this threshold. So, Scott, you mentioned it was on the margins. Our data shows that it's probably actually a majority more than a marginal benefit. So that's really interesting, I think. Yeah.
Right. Yeah, it's usually, with companies that burn off their money, it's usually that big slug that comes in those rounds that'll push you over the top. Otherwise, if you're cycling out the money like some pharma startup.
Yeah, you could get to Series C, Scott. Under that. So.
Yeah. Okay. Yeah, that's important. And the other place where I'll kind of in my comments where it can come in we work with companies that, are the, private equity with the platform company, and then they're doing add-on acquisitions. This is probably at the margin going to allow maybe for squeezing in another acquisition or two, depending on the size of these roll-ups that they're doing. So, I see a lot of that planning. I mean, for the original founders of the fund that's going to own the platform and then go forward, they're all right. But, we have these issues on employee plans and rollovers in there. And this 50 to 75 million, I mean, there's going to be a swath of additional ability to issue qualified small business stock in those roll-up arrangements.
All right. So with that, we hit 1 o'clock in the east, 10 o'clock in the west. So we have more to even cover. This is an evolving area. Lots of things that can be done. Some answered questions. So we contact information will be on the slide deck that you guys will receive. So feel free to reach out to Scott and me, Brady, with questions that you may have. Happy to talk about those offline. So again, thank you guys for attending.
Thanks for listening to this episode of QSBS Solved. We hope to hear from you soon. Remember that the content shared on QSBS Solved is for informational purposes only and should not be construed as legal, tax, or investment advice. While we discuss strategies related to qualified small business stock, or QSBS, including rollover planning, listeners should consult their own tax, legal, and financial advisors before making any decisions. Laws and interpretations can change. Individual circumstances do vary.